Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolio and protect your wealth. Remember to subscribe, like, and share these videos. Before getting into tonight's video, I want to make an announcement that we set up a Facebook group. It's at facebook.com/groups/The Kendall Report. And you go there and sign up. There's going to be exclusive content. There's already quite a bit of content that I put up over the weekend, and we're going to be having special events there. There's extended market grid offerings right now. So if you watch the channel and you want to become a bigger part and learn more about what I'm doing, just join our Facebook group. Also, this is a shortened week. We will be having a WaveTech training meeting, and that will be at 4:30 Eastern time on Tuesday. Now, one of the things, even if you're not a user, might be worth watching. I'm going to be building the capacity portfolio, and I'm also going to be showing you how to use our fundamental screens that we're releasing very soon to build your own PMF or personal mutual funds. Now, this is about the serious money, 401k, other type of retirements, and just money you're trying to grow, not speculative money. So make sure you show up to that. Just looking back on last week, we had quite the week as we got a RXT signal on Wednesday, signaling that S&P, NASDAQ, Apple, and Tesla were going to have 2 to 3 days of sideways to down. We got more than we asked for as these markets plummeted substantially, with the S&P moving down to the 3360 level before finding a low. There's several things that came out of this event last week. The first is that the RV, or the range volatility, which is the primary driver of the market grid that I release every day, has increased to 119.75. What that suggests is that we will see very broad trading ranges throughout the week. One of the things that I will talk about in the technical section is the exact setups, because we went from a trending market to a trader's market. So this is going to be very powerful as we go forward, and I'll be laying out all of the parameters on how to trade this market this week. The second thing that will come out of this high volatility is expect the machines to be there. Otherwise, all the algo traders are going to be out in force, and all the switches will be on full. So that's what's going to drive this volatility that we're going to see. Now, these guys have been dormant as we saw a lot of normalization. I talked about that several weeks ago, that the market's normalized, and now we're right back into that high volatility range. And I'll cover a lot of these details on the live stream on Wednesday. Make sure you show up at that at 1:30 Eastern time. The third thing that came out of the volatility and the collapse in prices last week is something I've been talking about for multiple weeks, which is this leadership change. Now, I expect to see these spreads start to move substantially. Otherwise, we're going to see the small cap, mid caps, and even the S&P outperform the NASDAQ on a relative basis. The volatility that we saw last week in the sweethearts of Wall Street, the Teslas and the Apples, absolutely scared a lot of folks, and this will cause people to look for other areas to invest in, and that's that rotation or leadership change that I've been talking about. It's been unfolding for a number of weeks. There's been some great ideas in the mid-cap and small-cap asset class. This rotation or leadership change will be what drives the markets forward if the economy is going to continue to expand. As I mentioned in the announcement, I'm going to be working on the capacity trade, and this is important also to understand. I talked to a couple of friends that traveled this weekend. They told me the airports were busy and the planes were full. So it's interesting to see how this economy is going on, and this capacity trade will be key going forward. With this holiday shortened week, fundamentally, we're not going to see a lot come out. We do have consumer credit coming out on Tuesday, expected to be up 13.5 billion. Should continue to expand. It was 8.5 in the last report. So we're looking for an expansion there. On Wednesday, there's absolutely nothing of any material effect, but Thursday, it's back to the claims, expected to show 850,000 increase. Continuing claims is the number that you want to watch. It came in at 13.2. I expect that number will come in below 13.2 this week, demonstrating that the economy is continuing to come back. We're starting to see some of these metrics not come in as expected, as I've been talking about over the past several weeks, I do believe the economy is going to continue to come back on track, and more jobs are going to come back, and it's going to be a gradual healing from this point. The last element that will be out on Friday will be CPI. I don't expect to see anything from that. It's expected to come out up 0.3 unless that number came in a lot bigger than expected. I don't think market participants are going to pay much attention at all. Let's go ahead and take a look at the charts, see what they're telling us for this week. As we begin with the WaveTech database, something I've been talking about for the last several weeks is I was expecting the short-term database to absolutely implode and drop to 28%. It's exactly what it did. It's at 27.79. And we saw a lot of selling over the last several days. In fact, there's 14,000 total sells over the last 2 weeks and only 3,000 buys. This is the type of ratio I was expecting to see. Just for Monday's opening, there is a lot of liquidation going on yet. There is 4,800 sell signals, only 200 buys. So both of those sentiment ratios are negative. You'll see up at top here we're at 27.79. And also as we look at the grid of the sectors, there's still 5 sectors long on the daily. There's 41 groups. So roughly 40% of the groups and the sectors are still long, and now 27% of the symbols. The reason why I focused on this over the last couple of weeks is this is the recycling of the database that you're seeing. On a short-term basis, it'll roll over like this. It will consolidate. I talked about a 4 to 6 week period. There's substantial support under the market, which I'll cover in the technicals here in a minute, but this will grind out, start to set up a lot of positive patterns, and then I expect to see this database move back into a positive range above 40% and ultimately toward the 60 to 70% level. I don't think there's going to be as many stocks rotating in on a short-term basis as we've seen before, because this database had went to 90, dropped to 65, back to 90, now it's to 27. So this liquidation was a nice washing out and cleansing of a lot of short-term trends, but it will take a while to repair, at least from a short-term basis. But as we switch over and look at the intermediate, we have now moved up to 70.6% bullish. There was actually about 700 new buys and about 400 sells, so it's slightly bullish overall. There is a negative ratio on 3.2 model, but we did see some further traction. It was at 69%. I have discussed this as well, as I believe this will get somewhere between 72 and 74%. Now we look over on the right side of the grid, the optimized weekly, roughly these models hold about 205 market days. Right now, the current duration fulfilled is 21%. We're 44 days into this cycle. There's a lot of forward-looking returns yet. As you can see, the current average profit is 7.25% and is about 25% filled, as the average profit is 29.875. So there's a lot ahead for this market on an intermediate term basis. And with this short-term database rolling over and this consolidation that I've been talking about setting up, ultimately the markets will trade in a broad range, will consolidate here, refresh, and be ready to resume a rally sometime possibly on or before the election. As we review the S&P 500 futures, we're starting to already see the sideways range set up. And trading this market this week is going to be critical to watch the market grid, and I will set up some broader ranges when we review the weekly cash markets here in just a minute. And I would use the cash markets to key off of, as the futures numbers are going to be a little bit different because of basically of a 24-hour cycle versus just the primary cycle of the S&P 500 day. The market grid on the futures will be useful, but the market itself will be dominated by the weekly market grid on the cash market. On the daily grid for the futures today, the range is kicked up substantially. On the cash markets, 119 handles, and we're seeing a potential range today on the upside of 35.52. The realities are this market's going to be throttled somewhere around R1, and the key will be how we trade in the first couple hours today. If we hold 34.04 on the futures, so far overnight we've had a 23 low, so we're not even close to that. But if we do dip down in the morning, as long as we hold that 34.04 level, we should see a possibility of an S1 R2. That would be the extreme. We should see an S1 R2 would be the upper end of the range, and I discussed on Friday's video that I thought we could move back toward the 3,500 level, and that still looks like that's going to be the case. And as I mentioned a minute ago, I will lay out the trading parameters for the week here in a minute, and I'll continue to update these as we get market action as we go through the week. For today, 34.04, if that number is taken out, then 33.73 is going to be a big number. And there is some other support numbers that I will show you here in the weekly charts on the cash. Let's go ahead and take a look at those. Reviewing the S&P cash markets, we're seeing that the market grid suggests that R1 is 34.52 and then R2 is 34.80. The key number on the cash is 34.01. That will be similar to the 34.04 level on the futures I just mentioned. So 34.01 is key. If it breaks that, 34.73 will be the next number. And I will be able to set up the weekly trading range for this week. And my suggestion is that when you get to these higher end ranges, that you'll look at an intraday reversal on a 5 or 15-minute chart, and you'll be able to trade these grid numbers pretty accurately, especially if they stretch into an R1, R2 number. As the week unfolds, I'll continue to update what key numbers are going to play out day by day. But the weekly grid also suggests 34.01 on the daily. 33.97 is the key number there. And this is where the 33.60 number comes in. 33.63 is key. Last week's low was 33.49, so we traded just below that number. The extremes for the week are going to be S2, R2 is what I'm expecting. That would be 33.63 to 34.90. For tomorrow, most likely it's going to be a 34.56 number. I don't think even if we penetrate through that, we'll trade up much above that. But anything close to 34.90, you can be able to play the other side and short this market. And around that 34.01, 33.97 on the downside, those are going to be your best points to play alongside at the lower end of the range and reverse this up. Now you may be able to put some option strategies on that you can trade a 2 or 3 day trade on that. But this is the likely pattern that we're going to unfold. If we did get through 33.63, then you can see the numbers here, 33.30, which would be a new low from last week, and 3,300 would be the extreme for the week. Will be 33.63 to 34.90. My expectation is that we could see an S1 R2 number for this week. I'm not sure with the shortened week, there's not going to be a lot of news to drive the markets. It will be all about the algorithms for most of the daily intraday volatility. Before moving on to the NASDAQ, the VIX did have a volatility spike last week. We got a close above the RXT. We did close down the next day. We should have at least 1, maybe 2 days of lower VIX prices. That also suggests that we're likely to see some upward bias for the next 2 days. Any dips early on Tuesday will be a tradable move up toward this level of that I just mentioned, between that 34.53 to the 33.92 level. Most likely the 33.53, 56 numbers are going to be the top end of the range today. Right now we are up 0.25%, 11,529. R1 is 11,636. S1, 11,365. The low so far has been 11,400. 470. So we're trading between R1, S1. My expectation is that it will be an S1, R1 day, possibility of getting up to an R2 and going to 11,788. I won't be covering Apple or Tesla, but I do think the spike that we had off the low on Friday is substantial, and I think there will be a bias as the bargain hunters are going to be out looking to buy Apple and the Teslas and some of the other stocks that took a hit last week. So those are also going to be in this trading mode. On Wednesday's live stream, we'll be able to talk about this a little bit more and see exactly what we saw on Tuesday and part of the day on Wednesday. There are a couple key points when we look at the weekly NASDAQ futures. S1 is 11,370. That's going to be a substantial number. And you see S2 is at 11,170. The 10-week moving average is 11,170. So that would match, suggesting we could see an S2 number. If the NASDAQ trades down to S2, 11,170, there's going to be a substantial bounce off of that level. If we do that early in the week, then expect to see a move from 11,170, possibility of trading a minimum of 11,729, maybe trading up toward 12,000, going to R2 at 11,927. The next market I will cover is the US dollar. The dollar continues to gain strength off of these lows. Had a nice spike the other day and a reversal pattern. We're seeing higher prices again. We talked about moving towards the 93.80 level. There's going to be substantial amount of resistance there. If you look at the market grid, 93.83 is R3, 93.86 is the 10-week moving average, and that average is declining at 0.43. Tells you that there's only a 30% probability for it to rise above that level. The real reason for covering the dollar is we are starting to see a bottom form here. You'll notice on the right-hand side that PPM1 has now crossed its first derivative. PPM2 has not done that, but PPM3 is very close to doing the same thing. This is the beginnings of a intermediate bottom, and we're most likely going to move back toward that 200-day moving average, and that's currently at the 96.30 level. So this is going to be a multi-month move higher, and this will ultimately put pressure on the metals as well. But this pattern is substantial. It is material. As I've talked about in the past, this was probably the single most crowded trade next to Tesla and Apple that there was out there. Everybody was short the dollar. So there's a lot of unwinds to be done in this market. Well, I'm not going to cover the 10-year notes tonight. There's further signs that the interest rates are bottoming, and we're going to start to see higher rates as we finished at 0.72 on Friday. I'll cover that in tomorrow night's video. Reviewing the daily gold chart, we are continuing to trade just below the moving averages. The 10-period moving average is 1963, 1984, and 1917. We're slightly above the 40-day moving average, which is a positive. 2 weeks ago, we had a low at 1908. That's going to be a key number on gold. If that's taken out, then we're likely to see further declines. Looking at the grid, you see that S3 is 1904, so that would be a support number where maybe we spiked under 1908 and got a reversal, but immediately you're looking at well under the 1900 level and going down to extreme of 1891. Expectations here is that the PPM1 is bottoming. There's a good chance that we're going to try to move back toward 1963 over the next couple of days. If it fails and closes under the 1919 level, that's going to be a problem, setting up a potential move to at least the 1891 that we see on the grid here. As we review the weekly charts, looking at the market grid, 1913 is also a key low on S1. Below that is 1889, which is similar to the 1887 on the daily extreme, and then 1866, 1845. Now it's critical that we remain above this 1919 number I mentioned a minute ago. We have the 10-week moving average 1934. It is rising at 0.65. On ppm1, we have crossed through the first and second derivatives, which does suggest there's some risk of going down, but I do believe that 1913 to 1904 will be a low. I don't see any trades off of here. I think the market is fairly dangerous just because of the analysis in the dollar and the potential for the dollar to keep moving higher. There could be some short-term risk here. We're basically in no man's zone on the gold right now, so you're going to have to be patient, and I will be covering this every day this week. This will complete the video. Thank you for watching. We'll talk to you tomorrow night.